Good morning, and thank you for joining us on the Power at Work blog today, where we'll be talking about the latest job numbers that have just come out from the Bureau of Labor Statistics at 8:30. So we have here with us two of my favorite labor economists who will be joining us to discuss the numbers today. We have Harry Holzer, who is a professor of public policy at Georgetown University's McCourt School of Public Policy. Good morning, Harry. It's good to see you.
Thank you, Alicia. Same here.
Excellent. And joining us again, who's a favorite on the Power at Work blog, is Aaron Sojourner, who is joining us. He is a senior researcher at the Upjohn Institute for Employment Research. Good morning, Aaron.
Hi, Alicia. Hi, Harry.
Good morning.
All right. Well, I'm going to give the headline numbers today since Seth Harris is on vacation. So he's letting me fill in his very big shoes here. So the Bureau of Labor Statistics report, as I said, just came out at 8:30 this morning, and we're giving you the basic headline numbers as well as our take on them. Unemployment rate was at 3.5%. It was largely unchanged from the prior month, so not a large increase in unemployment. The number of jobs created in July was 187,000. That's a little bit below expectations. Economists were expecting around 200,000 or so. It's also below the average that we've seen over the last year, which has been running around 300,000. But if we look back at where we were for the numbers that were reported in June, if you take into account those revisions, the revised down number was about 185,000. So we're kind of level for where we were at last month in terms of job creation. Wages, again, are up. They're up 14 cents or 0.4% compared to last month. And we look at an annualized rate that's about 4.4% over the last 12 months, or a little bit faster, about 5% over the last 3 months or so. So still seeing continued pretty strong wage growth there. When we look just across some of the broader sectors in terms of where we're seeing this slowdown in job growth and job creation, it's pretty broad slowdown across many sectors, although we still see strong job growth in healthcare, social assistance, financial activities, and wholesale trade. And for now, labor force participation, again, holding steady as it has been over the past several months, as well as prime age labor force participation. So now I'm going to go to each of our panelists here in turn and dive in a little bit into these numbers and get their first reactions. So first, I'm going to go to Harry. Harry, are these numbers good for workers, bad for workers, or are they a mixed bag? Give us your brief reaction to these headline numbers.
My view is that it's good because I'm looking for a Goldilocks labor market, not too hot, because if it's too hot, the Fed will jack up interest rates more and cause a downturn. Not too cool, because that means maybe that downturn has started. What I want to see is steady progress, steady and sustainable progress for American workers. And I think these numbers say that. The 187 payroll growth number that Alicia mentioned, coupled with the revision of last month to 185, now you have 2 months in a row of below 200,000. Which is considerably less than we've seen in earlier months, but you're starting to get in a range of labor force and payroll growth that's sustainable. And that doesn't, still strong, by the way, by any historical measure, still strong, but more sustainable. And then the wage growth number, Alicia, as you said, it's in the 4 to 5% range over the last 3 months, over the last year. That's probably still a little high for the Fed's comfort. Now, and as labor economists, we like to see it. We like to see, and inflation recently has come in at 3%. So that implies some nice real wage growth for workers. And that might make the Fed a little antsy, but I'll quote one other number from yesterday. We had a very good productivity growth number yesterday, much higher, I think the highest number in at least 3 years. And when you have productivity growth does not always show up in workers' paychecks. But when you have high productivity growth and an ongoing strong labor market, I think there's more pressure on employers to share in the productivity growth with workers. And that's a really good thing, because then you really can have wage growth ahead of inflation without setting off alarm bells. So I think overall, I view it as a quite positive report.
Great. Yeah. I mean, I think, on the face of it, when you see a job growth number that's below expectations or below, the really hot labor market that we've seen over the last several months, your first instinct is to say, whoa, what's going on? Is this really still a good story for workers? But as you said, we're kind of getting back to what's a stable, maintainable job growth, right? That isn't going to be accelerating inflation or, potentially overheating the economy, which is really good. I mean, it is the smallest gain that we've seen since about December 2020. But again, we're back to sort of the pre-pandemic operating maybe of the labor market, and coupled with that great news on productivity. I think that's a much better picture than folks would take away from their initial glance at what this number is. Aaron, what did you think about today's report? Do you think it's good for workers, bad for workers, mixed bag? What's your sense here?
Yeah, I agree with Harry's points, and I think it's definitely good for workers. Shows sign of continued employer demand in the labor market, moderation towards what the Fed will think are more sustainable pace of growth. I think something really good that Harry touched on, just to put a number on it, over the last 3 months, wage growth has been about 4.9% at an annualized rate, compared to about 2.7% for price growth. So that's 2.2% real wage growth for every hour you're working. You can buy 2.2% more goods and services than you could 3 months ago on average for American workers. And that's good news, because with the spike in inflation in the recent past, people did lose ground, and it's good to see that ground being made up.
Well, I think, I'm going to make it unanimous, which is just, I think, kind of crazy when you get three economists talking about the same topic and we're all agreeing about it. But I do also think that this is a good jobs report for workers. It's not, like I said, a big jump or, an overheating kind of number, but it's consistent, it's steady, it's kind of a return to what we would have considered just a healthy labor market. I think along with not just the productivity number, but the good numbers we've seen on GDP, the good numbers we've seen on consumer spending over this, last month. I don't know if that's, the Barbie movie or revenge travel. There's a lot going on this summer with consumer spending, but people seem to be able to sustain, this level of economic activity that keeps the economy chugging along, keeps the labor market in a healthy spot. And I think overall that's good for workers. And then I think coupled with the wage growth that we've seen, again, to Harry's point, that, that prosperity is being shared with the workers, right? It's not just being kept with the firms. All right, so I'm going to jump back to you, Harry, and I'm going to ask you our second question here. What are the numbers below the headlines that you think are important this month? So what's something that caught your eye in this report that maybe not everybody's talking about, but that you see as, something we should really lift up?
A couple of things. The labor force participation rate stayed at 62.6%. Now, we had a bunch of months earlier this year where the labor force was steadily increasing. Prime age women were coming back to the labor force, immigrants were pouring in, and that helped us to sustain the really high payroll growth. But now for several months, it has flattened out, which now means it's more imperative maybe to get the payroll growth down to not have more imbalance in the labor market between supply and demand. So it seems like the progress we've made on the labor force participation is not eroding, but it's flattened out, and that has implications for the rest of the economy. The other thing, I noticed a few other small indicators of slowing in the labor market. Weekly hours dropped only by 0.1% from 34.5 to 34.4. And that's usually a sign that employers aren't pushing their workers for long hours, that things are calming down a little bit. And the other thing is that temp employment, which is often pretty sensitive to the business cycle and to business conditions. Temp employment dropped, not a huge drop, 22,000, but similar to last month's drop. So again, when you see the temp numbers coming down, it might be, along with the hours decline, it's suggesting just a little bit of that heat in the labor market being pulled out and things calming down in what I think is largely a healthy way.
Yeah, so maybe, when you think about musical chairs, right? The music is kind of slowing down. Everyone needs to find a spot to sit down and have to be their permanent spot. I noticed, I think workers who are on temporary layoff has come down as well. So, it seems like, folks are getting plugged into the labor market, maybe where they need to be, and that we're getting to some stable level of work, right? Where it's not, just a bunch of workers who are working lots of hours and others who are shut out of the labor market. But as we bring more folks into different positions, employers can fill these roles, we can get to something that's more sustainable for everybody. Aaron, what are you seeing in terms of, what's your kind of nugget that you're going to take away from today?
Well, one thing I've been tracking is the employment to population ratio, the share of Americans employed who are African American and who are white. So if you go, we have data for the last 50 years, and historically there's been, I don't know, somewhere between like a 10 and 20% gap with whites having higher employment rates than blacks due to a combination of, a lot of complex factors that you can imagine. In March, for the first time in the data, African Americans actually had higher employment rates than whites, and it was just 1 month. But you could see that usual gap closing during this very tight labor market, and then it started falling again. And I've been paying attention to that, trying to see if we're gonna like revert back to the historical pattern with African American employment shares falling. But this month, actually, it stopped falling and, went up a little. And so, I don't know, I'm got my eye on that, hopefully stabilizing with a very small gap between the two populations, and hope for more equitable outcomes for all Americans, in the labor market ahead.
Yeah, I was just going to say, that is the tricky part when we do start seeing the labor market slowing down or not as overheated as before. When you have a super strong labor market, that is where you get to pull people in from the sidelines who maybe either have been marginalized or who have been waiting, until they're able to come into the labor market. So you think of everything from, historic populations that have been left out of previous recoveries, whether that's Black workers or, returning citizens or immigrants or women or whatever those groups are. And so we did see those gains for a while, and that, sort of historic moment where, we saw some real progress made. But this is the point where that part starts to wind down, but it'd be nice if it were, stabilizing. I know for myself, one of the things that I'm taking away from today's jobs report is, as usual, I have my eye on the teenage labor market, based on a lot of the research that I've done. And it's also, it's summertime, it's summer jobs. I know that City of Boston is working really hard to make sure that every young person who wants a job can have one. And we have the last 2 years seen an incredibly strong labor market for teenagers where, they're being offered jobs, not just in greater numbers, but also with, higher pay. So you're looking at, big box stores like Target and Walmart offering $17, an extra $2 an hour if you work the weekends or the nights. And that's super attractive to a lot of teenagers. And we've seen their, employment to population ratio increasing, more of them coming into the labor market to look for jobs. And so it's been a real, win for teenagers coming back out of the pandemic, where they had a 30% unemployment rate, in July of 2020. And now we're much below that. One thing I do want to point out, though, as you were saying, Aaron, I always keep an eye on the gap between different groups of teenagers, particularly for the July number, which is sort of the height of the teenage labor market. And it's, almost always the case that the unemployment rate for white teenagers is lower than Black and Hispanic teenagers. But we've really been seeing a widening gap over this summer, which is kind of surprising to me. So, for example, out of today's report for July, the unemployment rate for white teenagers was 9.5%. For Black teenagers, it was 20.7%, right? So almost twice as high, which is kind of the largest that we ever see that gap in terms of summertime employment. And at the same time, it's also just moving in the wrong direction, right? So I know we get blips up, we get blips down, but that Black teenage unemployment rate has moved from 11.7% in May to 15.6% in June to 20.7% in July. Some of that's to be expected as more teenagers come into the labor market to look for work, but by July you expect that to go down, and that's what we have seen in the white numbers, is that they initially blipped up a bit as more kids started looking for jobs, they land jobs, and then that number comes down. So I'm a little bit concerned with that. I'm not exactly sure where that's going to land. We do have one more jobs report in the summer to be able to see how teenagers land in the labor market. I do know some kids are still finding jobs, so I'll be interested to see where that lands as we get to the end of the summer. But I agree, it's definitely something to watch, and something that we hope some of the gains that we had in the previous months don't become undone.
I will say, even for the full population, the Black unemployment rate is still twice as high as the white unemployment rate. So those two things can go together.
And labor force participation among Black men remains pretty low. So I think the numbers are a real mix. We still have major disparities to worry about.
Yeah, absolutely. And I mean, I think for a long time, we've been saying that nobody wants to waste a strong labor market in workforce development. I know all of the policymakers that I work with have been pushing very hard to make sure that they can get their most vulnerable populations employed, that they can, make those job placements coming out of training programs and be able to slot workers into jobs. And so, a lot of those gains that have been made, it'd be great if there's a way for us to sustain that. I think last month we were talking about how, how this plays out in terms of worker power, and thinking about, do we want worker power really to be subject to the whims of the labor market? Like, oh, when it's strong, we have a leg up, but then how do we sustain those gains going forward? That kind of gets me, I guess, to our last question. I sort of already tipped my hat in that direction, but really, the focus here is thinking about how this jobs report speaks to what's going on with worker power. I know, we've had a lot more activity in terms of strikes, and also in terms of union activity. And so it's a really interesting time right now to be thinking about these dynamics as we're coming out of the pandemic, as we've had this crazy hot labor market. So again, Harry, I'm going to go to you first, and just give us our take on, what you've seen over the last, not just the last month, but the last 6 months to a year. Like, where do you think we are in terms of worker power? Do you think we're still on the rise here? How do you think this is going to play out as maybe we head to this soft landing?
Well, I think what we'd all like to see is continuing evidence of worker power, but again, at a level that's sustainable. And so a few measures, the quit rate is in many ways a pretty good indication of how much power workers think they have. That's been coming down from what we used to call the Great Resignation, and quits are almost back to sort of the pre-pandemic level. Maybe that's because workers have gotten rid of all their surplus savings that they piled up in the pandemic. Maybe they're worried about a downturn. So the decline in the quit rates suggests more caution by workers. On the other hand, the labor market by any measure remains very tight at 3.5% unemployment, vacancy rates much higher than that. And a tight labor market is a very good thing to enhance worker power. And again, if we get the soft landing, but at the same time maintain that level of tightness, a soft landing with still an ongoing very tight labor market, it is quite good news for workers, I think. And if we can keep that labor market tight, then workers have the power to grab a slightly bigger, or maybe not slightly, a bigger slice of that productivity growth that we saw in the last quarter. So I think this is quite encouraging, a sustainable level of tightness, worker power, and worker ability to grab a chunk of the nation's output, when in recent years, they've grabbed too little of that output.
Yeah, I think you raise a great point in terms of the soft landing, really being able to hopefully sustain some of these gains that workers have made, because a lot of times, right, we seesaw back into recession, right? Employers take back what some of those gains are. Workers are scrambling to be able to even just keep a job. It's been really interesting to watch over the last month or so. A lot of economists kind of taking back the R word, walking that back, talking more about soft landing. I don't think I've heard as many comments about soft landing in the positive way as I have in the last month. But it seems like we've kind of convinced the dismal field here that we're in that, okay, maybe it's going to be all right. And certainly when you get these jobs reports that are cooler and more stable over time, it definitely lends itself to that. Aaron, what are you seeing in terms of worker power? What's your kind of take on the summary of what we've seen today, as well as putting it into the context of the last, 6 months to a year or so?
Yeah, I mean, I think the big story is that, corporate companies raised their prices a lot and their profits a lot when there was supply constraints during the pandemic. And, the profit margins, or corporate profits per dollar sold, went up quite a lot. And now what we're seeing is that unwinding, that unfattening of profit margins. But if you compare a recent quarter to last quarter pre-pandemic, these corporate profits per dollar value added by the firm still up about 25%. And, wages are only up about 14%. Labor costs hourly are only up about that. So there's still room for labor market pressure by workers through quits, through organizing, through union contracts, through just individual negotiations, to claim, more of the share of the value that is created by the employer and the worker together in the job. And also, I think more scope to see, as these supply constraints loosen, new entrants come in, more competition, harder, sharper competition in product markets that dampen price growth, maybe even disinflate prices, bring prices down a bit in certain markets. And so both of those, higher labor compensation, lower prices, more competition in the labor market, more competition in product markets, those are going to unfatten profits. And there's still some scope for that to happen, for workers to be doing better, for consumers to be doing better, at the expense of the company owners, and they don't like it. But it, that keeps these gains for workers and consumers sustainable to some extent for a while still. So I think that's exciting. That's what we're seeing, and I think that's appropriate. There was this big ramp up in profits during the when these supply constraints were very tight. So kind of seeing that unwind.
Yeah, I think, one thing that's good also is that the demographics are on our side to some extent, right? And so baby boomers still are not getting any younger, and they accelerated their retirement a little bit during the pandemic. But even those who've been holding on, to that job as long as they possibly can, are moving into those golden years where they will be leaving the labor market. And it's just, a numbers game that the generations, the cohorts coming behind them are smaller, right? And so, that may also help us keep some sustained pressure in the labor market, where it's just not going to be super easy to go out and replace workers. And I think firms to some extent do know this, right? That even in any of the slowdown that we've seen, they're holding on to workers, right? They're not shedding workers very quickly. They worked really hard to find these people, to potentially train them, to put them into these positions. They know turnover is really expensive. They also know it could take a very long time to get those workers back based on recent experience. And so I think that is helping us extend, this tail of, feeling that labor market pressure and having it mean something for workers. The thing that's also, really, I think, incredibly helpful is when you do have inflation running below wage growth, then that does mean, right, that workers have more money in their pockets. That helps them sustain consumer spending. But then that also means that they feel more secure in their position in the labor market because they are getting, that real wage bump where they can potentially save, where they can potentially invest in education, in training, in a variety of ways of, being able to even move up in the labor market. I think that would be the thing for me that would really solidify these gains, is if we could help people move up in the labor market. We've been really good at drawing them back in, getting them into entry-level positions that are paying a decent wage now. But what does that career trajectory, look for folks, and how does that, maintain a sustainable wage as we go forward? I think one of the last things that we'll probably be watching very closely over the next month is what the Fed does with all of this information that they're getting. We know that inflation has been coming down. We're in a better place than we were a year ago. We know that inflation in the US is lower than in Europe. So the Fed's done a really good job. We're all talking soft landing. But now it's decision time. And you heard Jay Powell say it's going to be very data driven. So they're watching very closely what's happening with this jobs report, thinking about what that maybe last rate hike is going to look like, where, I can't imagine it would be a very large one, but that is what they have been signaling, is at least one last rate hike. And hopefully that will not, further cool the labor market below something that's healthy, right? That's what we want to stay in, this nice Goldilocks environment that Harry was talking about. All right. Any final thoughts here from either of you before we wrap up?
I'll just say one more thing, Alicia, since you talked about sort of career ladders and upward mobility for workers. The other piece of that puzzle, besides worker power, workers need to have the skills that employers are really looking for. I've been a little concerned at the decline in college enrollments, especially community college enrollments. Maybe that's temporary. Maybe that's cyclical, because enrollments do drop in really tight labor markets. But I'm hoping we see a reverse in that, and maybe make some progress on strong workforce development programs. Biden administration is doing some helpful things on student debt. But I would like to see those numbers go back up, because workers do need a combination of strong skills as well as power.
Yeah, and we saw some real, great research evidence, a lot of good progress made with, sector-based programs that have, these really strong designs that are tied to an employer, an industry, a job, at the end of that training program. And so I feel like we've got some great evidence on what works, and it'd be great to invest in those, as you said, to keep this moving, keep that progress, that skills progress going. Any last thoughts, Aaron, on your part?
I'll just echo something you said, which is that I think our employers are traumatized a bit by their experiences and coming and trying to rebuild their staff after laying a lot of people off. And, they recognize the costs of creating jobs, like the search costs, the matching costs. And they see jobs now, I think, more than they did in the past, in recent decades, as assets, and recognize the value of those matches that they form, and are more reluctant to just destroy those. And I think that's good news for because those costs are real, and they get overlooked a lot by managers. So in one sign of that is that layoffs and discharges also have been quite low, and so I think that's good news, and that should also spur investment in on-the-job training and career development within the firm and within the employer. So hopefully we'll see more of that ahead.
Yeah, I think the cost benefit on turnover versus training is something that employers just lived in real time. And maybe that equation has changed a little bit, which would be really nice for workers, right?
Yeah.
Excellent. Well, thank you so much to my wonderful friends and fellow panelists here, Harry Holzer from Georgetown, from the McCourt School of Public Policy, and Aaron Sojourner from the Upjohn Institute for Employment Research. Thank you so much for joining us today. It was really excellent to have you here. And everybody else, please do go to the Power at Work blog, where you can not only see a recording of this live stream as we discuss today's jobs report, but there will also be a brief write-up as well. So you can take away some of the key points that we made in any form that you want, whether it's watching this blog post or whether it's in readable form. And we look forward to seeing you again on our next Jobs Day about a month from now. So thanks so much for joining us.